This is a demonstration of exercise 218, analyzing and journalizing transactions. So the problem states to journalize the transactions of Wilk Technology Services and include an explanation with each journal entry. And they give us the following accounts to use, and they listed several accounts. So when they give you these accounts, they're trying to help you so that you don't just make up some kind of an account title that doesn't work. So whenever a problem gives you account titles, make sure that when you're trying to decide what to debit and credit, that you look at the list and choose something that's in there. So we're going to go through in the list of transactions for Wilk Technology Services for May, and we're going to determine the journal entry. So the first transaction says that the business received cash of $105,000 and issued common stock to Zoe Wilk. Okay, so when you're reading a transaction, when you're reading what happened, be thinking in your mind, I need a debit and I need a credit. We know that cash is an asset, so cash will be increased with a debit. We know that common stock is a stockholder's equity account and will be increased with a credit. Okay, so when you're reading these, be looking for a debit and a credit. Now, it won't always be it can be an increase and a decrease. It can be two decreases or two increases. In this case, it's two increases. So we have an asset and an owner's equity account, and we're increasing both. So when we make this journal entry, we would debit cash for $105,000 and we would credit common stock for the same amount. Now, a lot of times it's difficult for students to think, how do I describe this? Well, you want to describe it kind of concisely, but keep most of the basic information. So what did we do? We issued common stock in exchange for cash. Now, your wording might be a little bit different, but the main thing is to just explain what you did. And you go, well, why would we need to explain it? Because someone coming back behind you needs to know where this entry came from. Some entries are pretty self-explanatory, but other ones, like especially in the general journal, they need an explanation. Okay, the second journal entry, or on May 2nd, we purchased office supplies on account. So again, we're looking for a debit and a credit. Okay, so office supplies is an asset. That's going to be increased with a debit. On account, what does on account mean? It means like a tab. We are getting it on credit. So what does it mean to get something on credit? It means that we have a liability. Liabilities are increased with credits. So there we have it. We have a debit increase and we have a liability increase. Okay, so when you're reading these, you need to be looking for the wording and looking at something in there that gives you an idea about the account. And you go, okay, well, I wouldn't know on account which account. Do I use accounts receivable? Do I use accounts payable? I mean, which is it? Accounts receivable is an asset. That's the account when people owe us money. Accounts payable is a liability. That's when we owe people money. So what are we doing here? We're getting office supplies and we owe people money for it. So this is going to be accounts payable. When we purchase it, it's accounts payable. Okay, so what do we need to do? We need to debit office supplies for $550, increase office supplies. We bought those. And then we need to increase accounts payable for $550 because we owe that money. We haven't paid it yet. On account means hasn't been paid yet. How do we describe it? Purchased office supplies on account. Almost just use the very same wording. If it's very short, you don't have to even change it. The next entry says that we paid $57,000 cash for building and land, and the building had a fair market value of $45,000. Okay, So sometimes one part of the transaction will be given to you and another part will not be. We actually bought two assets. We bought a building and we bought land. Those are going to be increased with debits. But the problem really only gave us the fair value of the building. So how do we get the amount for the land? Well, it makes sense if you paid $57,000 cash for both and you know the value of one of them, you can get the value of the other one by subtracting these two. And that's what we would do. So to record this entry, we would debit building for the amount that they tell us, okay, 45,000, and we would debit land for the difference, or 12,000, because we paid a total of 57,000 for both of them. So that's how you get missing amounts. If you're given two amounts, you can usually get the third amount subtracting them. Now, you notice that it is possible to have more than one debit and more than one credit. You can have two debits that equal one credit. That's very common. You can have three debits and three credits, especially in more advanced accounting classes. But we're doing things that are fairly simple because you're learning these for the first time. The next entry says that we perform services for customers and receive cash of $3,600. Okay, again, what we need a debit and we need a credit. We know, and I always tell students, go for the cash. You know that cash is an asset and it's going to be increased with a debit. So now we have our debit. If it's cash, it's always easy. You've got your debit. All you got to do now is figure out your credit. So what did it say we did? We performed services for customers. So we earned what? Service revenue, right? And what is service revenue's normal balance? It's a credit. It's increased with a credit. So there you go. There is your debit to cash for $3,600. And there's your credit to service revenue for $3,600. So each of these is always going to give you enough information to determine the debit and the credit, but you have to figure it out based on the information that's given to you. On the night, that said that we paid $350 on accounts payable. So if you remember, we bought our office supplies on account. Now we're going to make a payment to that vendor. So when we pay money, what is that? That's cash. What are we doing? We're decreasing cash. So this time cash is going to be a credit. So we're looking for a debit. What's the only other account that's mentioned? Accounts payable. So we know that we are going to be debiting accounts payable. But let's think about it. Why would we be debiting accounts payable? Because accounts payable has a normal credit balance and we're reducing it, okay? So it had a balance of $550 and we're making a payment of $350 to reduce that balance. So we would debit accounts payable and we would credit cash. The next entry on the 17th again says perform services for customers on account. So here we did it again, but what is different about these two entries? On the 6th, we performed services for customers and received cash. That's not what happened this time. We did perform services for customers, so we do know that we're going to have a credit to service revenue, but what is the difference? This time we extended credit to our customer. Again, when you see the words on account, it means that we didn't receive cash, so cash is not involved. Or I will say, it can say that you received payment on account, so I wouldn't necessarily say it can't ever say on account. But when you perform services on account, that means that we have given that person credit. So instead of debiting cash, we would debit accounts receivable. Now, why is it accounts receivable? Because someone owes us money. We're going to receive money in the future. So there is your debit, accounts receivable, and your credit is service revenue. Okay, the next entry is we paid rent expense for the month for $1,200. When you see paid rent expense and the money, you know that we actually paid cash. Okay, that's how you know that cash was paid. So when we pay cash, What is that? That's a credit. So we need to look for a debit. What is our debit? Rent expense. Remember, expenses are increased with debits because they decrease retained earnings, which has a normal credit balance. Okay, so when we close rent expense at the end of the month, it will decrease retained earnings. Okay, so we have our debit, which is rent expense, and we have our credit, which is cash. And again, if you have something in the entry that's cash, get the cash part first, and that will help you. Once you get your debit or once you get your credit with cash, it's easier to figure out the rest of the problem. The next entry on the 20th said we received $1,500 from customers for services to be performed next month. Okay, so this is where it gets kind of complicated, because now what we are doing is we are actually receiving money up front from our customers for something that we're going to do in the future. Okay, so it seems like that we would be debiting or crediting service revenue, right? But we can't. Why can't we go ahead and credit service revenue? Because we haven't performed any services. Okay, sometimes some businesses will ask their customers to pay things up front because they don't want to maybe take up their time or book an appointment for the next month unless they know that that person is going to has already paid the money. Maybe they don't have very good credit. But when you see the word received, what does that mean? We got cash. So there's our debit. So we've got our debit, but what is our credit? Okay, so this is where you have to go back up to your accounts that you were given, and you have to kind of look through these to try to figure out what is going to be my credit. It looked like it would be service revenue, right? But no, it's not service revenue, it's unearned revenue. Okay, so really, what is unearned revenue? That's the question. What kind of account would unearned revenue be? It's actually a liability. Now, why is unearned revenue a liability account? Because we owe that person something, right? We owe them either the services in the future, and at that point we would provide the services to them and debit unearned revenue and credit service revenue. But what if that order got canceled? What if we could not perform the services? We would owe that person their money back. Okay, so until we actually perform those services for that customer, we have to show that on our books as unearned revenue or as a liability, because we haven't really earned that. We may have to pay that back, or we've got to do something in the future to clear that liability because we took that person's money. Okay? Now, on the 21st, it said that we paid $900 for advertising in next month's IT Technology magazine. Okay, again, this is difficult in the beginning for students to understand, because they see that, we know we paid money, so we know we're going to credit cash, but the thing is, what are we going to debit? And a lot of students would probably say, I'm going to be debiting advertising expense. And if they had advertising expense in the list of accounts, you would really be tempted to use it. But when we pay for an asset in advance that we're going to use in the future or get the benefit from in the future, it's not an expense, it's actually an asset. And that's confusing in the beginning for students to understand. But when we give someone else money, just like we took someone's money, and we're going to get something in advance, we're not going to record the expense until we actually get the benefit. Okay? So in the beginning, when we purchase something in advance, we're going to actually debit an asset called prepaid advertising, and we're going to credit cash. Now, next month, the ad should come out, right? We should get our ad in IT Technology. And at that time, we will record advertising expense as a debit and credit prepaid advertising. and you go, wow, that just seems like a lot of work. Why don't we just go ahead and debit advertising expense and get it over with? Well, it wouldn't be a problem unless we do our financial statements at the end of the month. And then at the end of the month, we would have $900 in advertising expense, but we haven't even gotten the advertisement yet. And that's misleading. So we want to record these. If we haven't received the benefit of it, we want to record it as an asset first, and then later we'll record the expense when we get the actual benefit. The next one says that we received $3,100 cash on account from a customer. Okay, so when we receive cash, we know we're going to debit cash, right? And we need to figure out what our credit is. So what does it mean when we receive cash on account? It means that we are getting paid from our customer for some credit that we've extended to them in the past. And we know that we did perform services on account, right? $3,500. And we debited accounts receivable. Now that person is paying us most of what they owed us, $3,100. So we would need to credit accounts receivable or reduce it. So we're going to record the debit to cash, and we're going to record a credit to accounts receivable, because now we're getting paid by the customer that we gave credit to. Our last entry on the 31st states that we incurred and paid salaries of $1,700. Okay, so again, if we pay something, we know we're going to credit cash, but what is our debit going to be? Well, it's an expense, right? Salaries. We're paying our employees, so we both incurred it and paid it. That means that the expense occurred at the same time that we paid it. So there's no liability involved like salaries payable. It's just cash, and the expense is owed. The employees have done the work. That's what the incurred portion means. So we would debit salaries expense and credit cash. And that is the conclusion of exercise 218.